Welcome to week 4 of Sally's dog walking business. Business is thoroughly underway, and we incurred a few interesting things in week 3 with some accounts receivable and some changes in inventory. So now let's dive into week 4. We're going to start with a few common transactions and then move on to a few that are a little different and new. Okay, so the first one to get week 4 underway is we're going to do a bit of a bulk entry of our regular customers, and all walking orders repeat. So this is our 4 customers that have placed some walking business with us. They're all going to repeat, and that represents $220 in sales. We're going to rehire our sister for $100. So that's going to leave us with $120 of net income. Now, but customer number 4, this is the one that had an IOU last time. They've again asked for another IOU. They haven't got the money. So we say okay to that because we're pretty excited about our business and we want the business. So that represents the $120 of net income. That comes in the form of $70 cash and $50 in accounts receivable. So let's go ahead and enter that one. So go ahead and pause the video and have a crack at entering that transaction. Okay, so $220 in sales, $100 in labor leaves us with $120 of net income. So immediately we know we can put our net income up by $120. So that means that on this side of the ledger, things have to go up by $120, and we know that we've got $70 in cash, $50 in accounts receivable. Those two together equal $120. So we get $70 in cash, so that goes to $74, and our accounts receivable goes up by $50, so that goes to $125. So looking at that, we can see that our total assets and equals our equity plus liability, 544. We are in balance. Moving on to transaction number 17. Now, Sally's been working hard for a while now, but she hasn't taken any money out herself. And she says, well, I've made all these sales. I've got, down here, 120 in net income so far this week, 224 in retained earnings. So, all up the business has made $344. So surely Sally's earned some cash here. She needs to take some money out to feel the rewards of her business. She'd like to take a full $100 out, but she's only got $74 in cash. So she decides to give herself $50. And a couple of ways that we could take this $50. We could pay ourselves a wage, like we pay our sister a wage, or we could take it out of the owner investment down here in equity. We've already put $100 in that's represented here, so we could take some of that back out, or we could issue a dividend. We're not going to deal with dividends right now. We're going to leave the choice between wages or reducing the owner investment. And Sally's decided the best way to do it right now, because she wants to keep her income looking high, is to take out some of her initial money that she put in, the owner investment. So go ahead and have a go at making this transaction. Okay, so Sally taking the $50 out. We said we're going to take out $50 here. So that's going to go down to 50. 100 minus 50 is 50. And that means we need to make a transaction on the cash side of the ledger. We took out $50 in cash, so cash goes down by 50. So down to $24. Okay, total assets of $594, equity plus liabilities of $494. We are in balance. Okay, let's move on to transaction number 18. Now, with all our fantastic customers, they all love Sally and the effort that her and her sister are doing. So when Sally goes to them and says, hey, would you like to buy some food, or would you like us to feed your dog? They all say yes. Now, customer number 4 is already buying food, but Sally managed to upsell all her customers. So she's selling a total of 20 meals at $5 each. That's 4 dogs, 5 meals a day, roughly $5 each at a cost of $3. So, and they're all paying cash for this. So that means that we've got $100 in sales and we've got $60 in inventory costs. So go ahead and make this transaction. Okay, so this one is a little tricky. So we got $100 of cash coming in. We incurred costs of $60 in terms of our dog food inventory. So that means that we've got $40 of extra net income. That is 100 minus 60 equals 40. So that goes up by $40, our net income. So it goes to 160. Now that one went up, so we've got to come up by the equivalent on this side, and we know that we brought in $100 of cash, so that goes to 124. That's the $100 we got paid, but we also used $60 worth of inventory, so this goes down by 60. So that's going to be 25 there. So now our assets are 534, and our equities and liability is also 534. We are in balance. Good-o. Let's take a look at transaction number 19. Sally's looking to continually increase the value she's bringing to her customers and wants to differentiate a little bit. So figures that the dogs would be happier and more exercised if she's got some toys to throw around for them to chase. So decides to go out and buy some toys, and she's going to pay cash for this. So go ahead and make this transaction. All right. So paying cash for dog toys. So dog toys down here. So obviously we go down by $80 in cash. So that's going to be down to 44. And our dog toys goes up by $80. There we go. So once again, assets is 534. Equity and liability is 534, so only changes made to the left side of the ledger there. We were just swapping some cash for some dog toys. Okay, transaction number 20. Things are going strong, but Sally's looking at her state of her cash, and she's down at $44. And she's in a position now where if she wants to sell more dog food, she's going to need to, or more feeding services, she's going to need to have some more inventory. So, and she's also thinking that down the track, she might want to buy a bit more equipment. You know, things are growing, so she wants to have a bit of padding there. So she decides, I'm not going to go back to mum. I'm going to go to the bank this time. I've got some transactions there. I can show the bank I'm profitable and the business is growing. So they should be willing to lend me some money. So Sally trots down to the local bank, talks to the banker, gets the application. The bank says, no problem, happy to lend you $300. So they give her $300 in cash to get her through. So why don't you go ahead and try entering that transaction. Okay, so bank lends $300. So over here, you see now we've got, this is interesting, we've got a non-current entry versus the current entry. The difference there, as we explained back in the video on the financial statements, current means that it is imminently payable. And when we say imminent, we're normally talking 12 months. Obviously accounts payable, you're not going to take 12 months to pay your accounts payable. But things like a bank loan, you would normally take a bank loan out with a 3 to 5 year payback period. That might be a little stretch for Sally's business, but for the purpose of the example, we're going to show that a bank loan would sit typically in a non-current liability part of the balance sheet. So that is going to go up by $300 because we owe the bank $300 now that they've loaned us the money. And obviously our cash is going to go up by $300. That goes to $344. So we've made an entry on both sides of the ledger for $300. Total assets now $834. Equity and liabilities also $834. We are in balance. Okay, now that Sally has some cash, she's got $344 sitting in the bank. She thinks it's probably a good idea to go and settle up with the dog food supplier. We want to make sure we keep our suppliers in the good books and keep them happy. So she's going to settle up with the supplier, and also figures that she's been working pretty damn hard. And so far, her sister has earned, $300 so far, and all Sally's pulled out is $50 to pay herself. one of these examples where employees are earning more than the owner. So she decides it's time to pay her some money. The cash is there, so she's going to take out $150 for herself. So we're setting up with the dog food supplier, paying $100 cash, and also taking out $150 for the owner. Now you'll see down in the equity section, we've got a new line in here called dividends. And this is another way that an owner can take money out of the business by issuing dividends. And the difference there, I mean, this is getting a little detailed, but there can be tax advantages to taking dividends versus paying yourself a wage. I'm not going to get into the pros and cons of all of that because that is way beyond this exercise and also very specific to your particular situation. So that's certainly something you want to discuss with your accountant. But for the purpose of this exercise, just to show how the entries are made, Sally is going to take the balance of her owner investment, which now sits at $50, and is going to issue the other $100 that she wants out of a dividend. So have a go at entering these two transactions. Let's see how we go. Okay, so two transactions, $100 to pay the food supplier and $150 for Sally. So that's $250 in total. So we know that that's going to be $250 in cash. So our cash is going to go down by $250. So that takes us down to $94 here. And we've paid off the dog food supplier, so that's going to go to zero there. And we know that $150 to Sally, $50 is going to come from here, from the owner investment. And we're going to issue a dividend of $100. Now this one's a little tricky. See if you got this one. It goes in as a negative number because we've issued the money out. Therefore, we can see that the assets is $584, equities plus liability also $584. We are in balance. Okay, let's take a look at how our income statement looks for week 4. So a bit of a summary on this side here. We can see our walking sales were $220, feeding sales were $100, food costs were $60, labor costs were $100, and no other expenses incurred. So why don't you go ahead and have a crack at filling out the income statement. Okay, this one is reasonably straightforward. We're just going to take these numbers here and throw them in. So our walking sales were set at $220. Our feeding sales are $100. Our labor is $100. And our dog food, that's the food costs, is $60. So again, it's interesting to note, well, just to finish off here, so our total cost of goods are $160. Gross profit is $160. And because there are no other expenses to deduct, net income is also $160. So just pointing out here that you can see that we've incurred a dog food cost here of $60 because we actually used $60 worth of dog food. But unlike week 3, we didn't actually buy any inventory. It was already sitting there. So the use of the inventory goes on the income statement. And once again, our accounts receivable doesn't show up anywhere on the income statement. The money that we paid ourselves doesn't show up on the income statement. The $100 that we paid to the supplier does not show up on the income statement. So you can start to see now, how many transactions can actually go on that don't show up on the income statement, and hence the reason why this exercise to date has been very heavily focused on the balance sheet, because the balance sheet is probably a more accurate picture of how a business stands in terms of health-wise, but you really need to be looking at all 3 statements to be able to see what's going on in a business. Obviously, you could have a healthy balance sheet but be losing money if up until that point, the business had been very successful. So you can't just look at a balance sheet, just like you can't just look at an income statement, you can't just look at a cash statement. So moving on. Speaking of cash statements, let's see. I'm going to let you have a go at this one. We've got it's been a busy week on the cash flow statement for Sally's business. You're going to have some entries in all 3 areas: the operating cash flow, the investing cash flow, and the financing cash flow. Your check and balance will be that you started the week at $4 and you ended the week at $94. So make sure that after you've entered everything in your statement of cash flows, that this ending period says $94. So if that's going to say $94, your net change in cash must be $90. Right? You went from 4 to 94, so the net change in cash must be 90. All right, I'll pause here and let you have a go at it. Okay, let's see how you did. This one was a little trickier. So we can start at the top with net income. Again, we can look at net income either from our income statement, see net income was 160, or from our balance sheet to see net income was 160. So that's our starting point. We're going to put 160 in there. 160. Changes in accounts receivable. We need to look at our beginning and ending balance sheet to look for the changes here. So to go back to our beginning balance sheet, which was also the ending balance sheet of week 3. So week 3 summary, the ending balance sheet said accounts receivable was $75. And sorry, beginning balance sheet accounts receivable was $75. The ending balance sheet, $125. So that means that accounts receivable went up by $50. And when accounts receivable goes up, it means that someone else has our money. So that is bad for cash. So therefore, we're going to put a negative number in accounts receivable, minus 50. Accounts payable. Let's go back and look at our starting balance sheet. Starting balance sheet accounts payable was $100. Ending balance sheet was $0. That means accounts payable went down by $100, which means we paid people. We paid people back. If we pay people back, that's bad for cash. That's cash going out. So bad for cash is a negative number. So therefore, it's going to be minus 100. Changes in inventory. Let's again go to our beginning balance sheet. Inventory was at $85 and ended at $25. So inventory went down. When inventory goes down, it means we're selling things. It means we're holding less stock. If we're holding less stock, that's good for cash. Good for cash. That's going to be a positive number. So that's a 60. Inventory went down by $60. Good for cash. Okay, so we've got a net change or a net operating cash flow of $70, which is interesting when you think about it, because our net income was $160, and we managed to turn $160 into only $70 of cash. Interesting. Investing cash flow. Firstly, purchase of assets. Did we buy anything? Well, yeah, we did. We bought some dog toys, and we spent $80 on dog toys. So that's bad for cash. Okay, so we put minus 80 in here. And sale of assets, we didn't sell anything. So our net investing cash flow is minus 80. Now, financing cash flow. Did we receive loans? Yes, we did. We borrowed $300 from the bank, so that's cash in, good for cash. That's going to be positive $300. Did we repay any loans? Nope, we did not, so that stays at $0. Distributed, this is the dividends. So we took $100 in dividends, so that's a negative number because we paid cash out. That's bad for cash, minus 100. And shareholder invested. Well, the word invested sort of, infers that money was put in, but this actually can be money taken out or put in by the shareholder. And the reason it differs from dividends is because typically when the business gets to a stage where there's no, shareholder hasn't got any invested money in there, when that account is $0, but they want to take money out that's not necessarily a wage or a salary, it then becomes a dividend. And in fact, you can take dividends even when you do have money invested, but it just becomes a different way of categorizing it. So in this case, just to keep things simple, we did take out the $100. Sally took out the $100 that she had originally put in to start the business. So that's bad for cash. So that's a negative 100 as well. So we can see there that total net financing cash flow is positive $100. So when we add these three up, the 70, the minus 80, and the 100, our change in cash is $90. So our cash at the end of the period is $94, just like it was on our ending balance sheet. So that's the way it looks. So it's interesting because here you can see that, the business, the way to look at this statement, we can see in the week 4, Sally did great on her net income, but her ability to manage cash flow in other areas, in accounts receivable and then paying off her accounts payable and her inventory management, all of that, added up to significantly less than her net income, which can be okay. I mean, that's going to happen. So it can be okay, but she also bought some assets, which again, investing in the business is okay, but it's how do you buy those assets? Do you borrow money to do it, or do you do it out of cash? And we can see that because she went up by $90 in cash, 70 of that came from operations, but a large portion of the cash that came into the business in this week was actually through financing cash flow. So when you go and look at another company and look at their finances, it's very important to look at this statement so you can see, how much operating cash flow are they generating, and then how much they need to borrow or what's their ability to pay back money, based on the equipment they have to buy. So remember that, your operating cash flow should be able to sustain the equipment that you want to buy in a business. If it can't, you're going to have to borrow money to do that. All right, so last activity on week 4 is to roll up our earnings. So I'll let you go ahead and do this one. So this roll up of the earnings is a little trickier. Let's see if you got caught on this one or not. I expect you probably did because I didn't give you much explanation. So whenever we roll up the earnings, we're really cleaning up the equity portion of the balance sheet. So there's two things we have to roll up here is the income and also the dividends. We want to bring those back to zero. At the end of a year, if dividends have been issued, that would get re-zeroed, so we can keep track of that in the following year and see the dividends that get distributed throughout a year. They don't compound on top of each other. So just to make this one simple, 160 net income minus 100 in dividends, so our retained earnings, once we neutralize these two, is going to go up by $60. So that one goes to 0, that one goes to 0, and this one will go to 284. 284. Total assets 584, equity and liabilities also 584. And that concludes week 4 for Sally's dog walking business.